Look, I'm going to be straight with you. While you're tossing and turning at 3 a.m. worrying about your portfolio, there's one asset that's been quietly outperforming almost everything else. And the crazy part? It doesn't need a CEO. It doesn't have earnings calls. It doesn't even need electricity. I'm talking about gold. But before you roll your eyes and think this is just another precious metals pitch, let me show you what's happening right now that most people are completely missing. Central banks just bought more gold in the last 18 months than they have in over 50 years. We're not talking about a small uptick. We're talking about a fundamental shift in how the world's most powerful financial institutions are positioning themselves, and they're doing it quietly, methodically, and with an urgency that should make every investor pay attention. Let me paint you a picture. Imagine you're the head of a central bank. You've got billions, maybe trillions in reserves. Your job is to protect your nation's wealth. Now you're watching the dollar weaponized through sanctions. You're seeing inflation numbers that don't match what people experience at the grocery store. You're watching debt levels that would make a gambler blush. What do? You buy gold. Lots of it. The People's Bank of China has been on an absolute tear. Month after month, they're adding to their reserves. But here's what's fascinating. Many analysts believe they're buying far more than they're reporting. Why? Because if they announced the true scale of their accumulation, it would send gold prices soaring before they finished building their position. It's like trying to buy every house on a street without the neighbors noticing. The moment word gets out, prices skyrocket. Poland's central bank governor came out recently and said something remarkable. He essentially stated that gold is the ultimate reserve asset because it has no counterparty risk. Think about what that means. When you hold a bond, you're trusting a government to pay you back. When you hold a stock, you're trusting a company to perform. When you hold dollars, you're trusting the Federal Reserve's monetary policy. But gold? Gold just is. It doesn't promise anything. It doesn't owe anyone anything. It simply exists as a store of value that's been recognized for thousands of years. Now, let's talk about what's happening in the physical market, because this is where things get really interesting. There's a massive divergence happening between paper gold and physical gold. On the COMEX, you can trade gold futures contracts all day long, billions of dollars worth. But here's the thing. Most of those contracts never result in physical delivery. It's just paper changing hands. It's a bet on the price, not actual metal. But in the physical market, that's a different story entirely. Premiums are rising. Wait times are extending. Refineries are running at capacity. The United States Mint has had to ration Silver Eagles because they can't keep up with demand. And this isn't just retail investors buying coins. This is institutional money, family offices, and sovereign wealth funds trying to get their hands on actual metal. There's a term in the gold market called backwardation. It's when the spot price of gold is higher than the futures price. In normal markets, this shouldn't happen. Futures should trade at a premium because of storage costs and the time value of money. But when backwardation occurs, it signals something critical. People want the metal now, not later. They're willing to pay more for immediate delivery than for a promise of delivery in the future. That's not normal market behavior. That's fear. Let me tell you a story about what happened in the 70s. Most people remember that decade for disco and bell bottoms, but something far more significant was happening in the financial markets. In 1971, Nixon closed the gold window. For the first time in modern history, the dollar was completely untethered from gold. It was a pure fiat currency backed by nothing but faith in the U.S. government. What happened next? Gold went from $35 an ounce to over $800 by 1980. That's not a typo. A 22 times increase in less than a decade. But here's what most people miss about that story. It wasn't a smooth ride up. There were massive pullbacks. There were moments when everyone thought the gold bull market was over, and then it would surge again, reaching new heights. The people who made life-changing wealth during that period weren't the ones who tried to time every move. They were the ones who understood the fundamental shift happening in the monetary system and positioned accordingly. They recognized that when you fundamentally alter how money works, there are consequences, and those consequences take years to fully play out. Fast forward to today. We're in a similar moment, but the stakes are even higher. The debt levels are exponentially larger. The money printing has been more aggressive, and the geopolitical tensions are more complex. We're not just talking about one country closing the gold window. We're talking about a potential restructuring of the entire global monetary system. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working on alternatives to the dollar-dominated system. They're settling trade in their own currencies. They're building payment systems that bypass SWIFT, and they're backing these efforts with gold. This isn't conspiracy theory stuff. These are official government policies being implemented right now. Russia, after being hit with sanctions, immediately pivoted to gold. They're now one of the largest producers and holders of gold in the world. They've essentially said, if you're going to kick us out of the dollar system, we'll build our own system backed by real assets. And other countries are watching this playbook very carefully. Here's something that should concern every American. For decades, the dollar's reserve currency status has been an enormous advantage. It's allowed the United States to run massive deficits without immediate consequences. It's kept interest rates lower than they otherwise would be. It's essentially been a free lunch. But what happens when that status erodes? What happens when countries start settling oil trades in yuan instead of dollars? What happens when central banks diversify away from treasury bonds and into gold? The answer is inflation, real inflation. Not the sanitized CPI numbers, but the kind of inflation where your purchasing power gets cut in half over a few years. The kind where retirees on fixed incomes watch their savings evaporate. The kind where the middle class gets hollowed out. And this is where gold becomes not just an investment, but insurance. It's insurance against monetary mismanagement. It's insurance against geopolitical chaos. It's insurance against the kind of systemic risks that most people don't even want to think about. Now, I want to address something important here. If you're sitting on $100,000 or more in retirement accounts, you need to understand how gold IRAs work. I've put together a comprehensive guide that covers exactly how to get physical gold into your retirement account without triggering tax penalties. It's in the description below. This isn't about abandoning your other investments. It's about diversification and protection. It's about making sure that a portion of your wealth is in something that can't be printed, can't be hacked, and can't be devalued by central bank policy. Take a look at that guide if this is relevant to your situation. But let's get back to what's driving this market right now, because the technical picture is absolutely fascinating. Gold recently broke through its previous all-time highs and has been consolidating at these elevated levels. In technical analysis, when an asset breaks out to new highs and then holds those levels, it's typically a sign of strength. It means there are buyers willing to step in at these prices. It means the market is accepting these valuations as the new normal. But what's really interesting is the structure of the market. Look at the commitment of traders report from the CFTC. Commercial traders, the big banks and institutions that actually deal in physical gold, have been reducing their short positions. These are the smart money players. They're not fighting this rally anymore. They're accepting it. Meanwhile, managed money, the hedge funds and speculators, are actually not as heavily long as you might expect. There's still room for more speculative money to enter this market. And then there's the mining side of the equation. Gold miners are in an interesting position. Their costs have gone up with inflation, labor, energy, equipment, but gold prices have gone up even more. This means their profit margins are expanding. But here's the catch. It's getting harder and harder to find new gold deposits. The easy gold has been mined. New discoveries are in more remote locations, deeper underground with lower grades of ore. This means the supply side is constrained even as demand is surging. Think about what that means for price dynamics. In any market, when demand increases and supply is constrained, prices rise. It's basic economics. But in the gold market, this dynamic is amplified because gold isn't consumed like other commodities. Almost all the gold ever mined still exists. It gets recycled, melted down, and reused. So the supply is really just new mine production plus recycled gold. And if people aren't selling their gold, if they're holding it as a long-term store of value, then the available supply shrinks even further. We're seeing this play out in real time. Jewelry demand in India and China remains strong despite higher prices. Central banks are buying. ETFs are seeing inflows again after a period of outflows. And the physical market is tight. All of these factors are pointing in the same direction. Let me tell you about what happened in 2008. When Lehman Brothers collapsed and the financial system was on the brink, gold initially sold off. People needed cash. They were liquidating everything. But then something remarkable happened. As central banks around the world launched unprecedented stimulus programs, as they slashed interest rates to zero, as they started buying assets they'd never bought before, gold began a rally that would take it from around $700 to over $1,900 by 2011. The people who bought gold during the panic of 2008, when everyone else was selling, made extraordinary returns. But more importantly, they protected their wealth during a period of extreme financial instability. While stock portfolios were getting cut in half, while real estate was collapsing, while banks were failing, gold was holding its value and then appreciating. We're in a similar setup today, but the scale is much larger. The stimulus in 2008 was measured in billions. The stimulus during the pandemic was measured in trillions. The Federal Reserve's balance sheet exploded from under $1 trillion before 2008 to nearly $9 trillion at its peak. That's money creation on a scale that's never been attempted in human history. And while they've tried to reduce it somewhat, it's still at levels that would have been unimaginable just 15 years ago. What does all that money creation mean? It means dilution. Every dollar in existence is worth less because there are more dollars competing for the same goods and services. It's like if you owned shares in a company and they suddenly issued 10 times more shares. Your percentage ownership would be diluted. The same thing happens with currency. But gold can't be diluted. You can't print more gold. You can't create it out of thin air with a keystroke. The only way to get more gold is to dig it out of the ground, and that's an expensive, time-consuming process. This is why gold has maintained its purchasing power over centuries, while every fiat currency in history has eventually failed. Think about this. With 1 ounce of gold in ancient Rome, you could buy a fine toga, a belt, and sandals. Today, with 1 ounce of gold, you can buy a nice suit, a belt, and shoes. The purchasing power has remained remarkably stable over 2,000 years. Can you say the same about any paper currency? The dollar has lost over 95% of its purchasing power since the Federal Reserve was created in 1913. The British pound has lost even more. Every fiat currency follows the same trajectory, gradual, then sudden devaluation. Now, let's talk about what's happening with interest rates because this is crucial to understanding where gold is headed. For years, the narrative was that gold doesn't perform well in rising rate environments because it doesn't pay interest. Why hold gold when you can get 5% in a savings account? That was the thinking. But something broke that narrative. Gold has been rising even as rates went up. Why? Because real rates, the interest rate minus inflation, are what actually matter. If you're getting 5% interest but inflation is running at 7%, you're losing purchasing power. You're going backwards. And investors are starting to understand this. They're realizing that nominal rates don't tell the whole story. Plus, there's a growing recognition that rates can't stay elevated forever. The U.S. government is paying over $1 trillion a year just in interest on the national debt. That's not sustainable. At some point, rates will have to come down, either through Fed policy or through a crisis that forces their hand. And when rates fall, gold typically performs very well. Here's another factor that's not getting enough attention: the generational wealth transfer that's happening. Baby boomers are passing wealth to younger generations, and those younger investors have different perspectives. They've seen the 2008 financial crisis. They've seen the pandemic response. They've seen inflation eat away at their purchasing power. They're more skeptical of traditional financial institutions and more open to alternative assets. And gold, despite being one of the oldest assets in existence, is being rediscovered by a new generation. The technology around gold ownership has also evolved. You can now buy fractional gold through apps. You can hold gold in allocated storage with full transparency. You can trade gold-backed cryptocurrencies. The barriers to entry have come down significantly. This is bringing new participants into the market who might have been intimidated by the traditional process of buying physical gold. But let's not forget the geopolitical dimension, because this is perhaps the most important driver of all. We're living through a period of deglobalization. The integrated global economy that we've known for the past few decades is fragmenting. Supply chains are being reshored. Trade blocs are forming. And in this environment, countries want assets they control, assets that can't be frozen or sanctioned, assets that don't depend on the goodwill of other nations. Gold fits that bill perfectly. It's the ultimate neutral asset. It doesn't care about politics. It doesn't take sides. It's accepted everywhere. This is why central banks are accumulating it. They're preparing for a world where the rules-based international order might not be as stable as it once was. Consider what happened when Russia's foreign reserves were frozen. Hundreds of billions of dollars held in Western banks suddenly became inaccessible. That sent shockwaves through central banks around the world. If it could happen to Russia, it could happen to anyone. The message was clear. If you want true reserve assets, you need things that can't be frozen, seized, or sanctioned. You need gold. This has created what some analysts call a prisoner's dilemma for central banks. Even if you don't think you need gold, you have to buy it because everyone else is buying it. If you don't, you risk being left behind in the new monetary order that's emerging. It's a self-reinforcing cycle that's driving demand higher and higher. Let's talk about the supply side in more detail, because this is where the long-term bull case for gold really solidifies. Global gold production peaked around 2018 and has been relatively flat since then. New discoveries are rare. The lead time from discovery to production is often 10 to 15 years, and the quality of deposits is declining. Miners are having to process more ore to get the same amount of gold. Meanwhile, demand is increasing from multiple sources simultaneously. Central banks are buying. Asian consumers are buying. Investors are buying. Technology companies need gold for electronics. The supply-demand imbalance is becoming more pronounced, and this is happening at a time when the cost of production is rising due to inflation in energy, labor, and materials. What does this mean for price? Simple economics suggests that prices need to rise to balance the market. Either prices go up enough to incentivize more production and reduce demand, or we see persistent shortages in the physical market. Given the constraints on the supply side, the path of least resistance is higher prices. There's also a psychological element to gold that's important to understand. Gold is a fear asset, but it's also a wealth asset. When people are afraid of inflation, of war, of financial crisis, they buy gold. But when people are wealthy and want to preserve that wealth across generations, they also buy gold. So gold benefits from both fear and prosperity, just in different ways. Right now, we're in an environment where both dynamics are at play. There's fear about the sustainability of current debt levels, about geopolitical tensions, about the stability of the banking system. But there's also enormous wealth that's been created over the past decade, and that wealth is looking for safe havens. Gold serves both purposes. Think about the ultra-wealthy. They're not putting all their money in stocks or bonds. They're diversifying into real assets, real estate, art, collectibles, and yes, gold. They understand that paper assets are only as good as the system that supports them. If that system becomes unstable, you want assets that have intrinsic value, assets that have been recognized as valuable for thousands of years. This is why family offices are increasing their gold allocations. This is why sovereign wealth funds are buying physical gold. This is why even some pension funds, traditionally very conservative, are starting to add gold exposure. The institutional adoption of gold as a portfolio asset is still in its early stages, and as it accelerates, it will provide sustained buying pressure. Now, let's address the elephant in the room: volatility. Yes, gold can be volatile. It can have sharp pullbacks. It can go through periods where it seems to do nothing. But zoom out and look at the long-term trend. From 2000 to today, gold has massively outperformed most asset classes. It's not about timing every wiggle in the price. It's about recognizing the macro trend and positioning accordingly. The investors who do well in gold are the ones who understand it's not a trading vehicle. It's a strategic allocation. It's the part of your portfolio that's there to protect you when everything else is falling apart. It's the insurance policy that you hope you never need, but you're glad you have when crisis hits. And make no mistake, we're living in an era of increasing crisis frequency. Financial crises, pandemics, wars, climate events. The world is becoming more unpredictable, not less. In this environment, having a portion of your wealth in an asset that has survived every crisis in human history makes a lot of sense. Let me paint one more picture for you. Imagine it's 5 years from now. The dollar has lost significant value due to continued money printing. Inflation has remained stubbornly high despite central bank efforts. Geopolitical tensions have escalated. The stock market has been through a major correction. In this scenario, what assets do you want to own? You want assets that can't be printed. Assets that don't depend on corporate earnings or government promises. Assets that have intrinsic value recognized globally. Assets that have no counterparty risk. Gold checks all those boxes. The people who are buying gold today aren't trying to get rich quick. They're trying to preserve wealth over the long term. They're trying to protect against scenarios that most people don't want to think about. They're taking out insurance while it's still affordable. Because here's the thing about insurance. You can't buy it after the crisis hits. You can't buy fire insurance while your house is burning. You can't buy flood insurance while the water is rising. And you can't buy monetary insurance after the currency crisis has begun. You have to position yourself before the crisis, even if you're not sure exactly when it will come. The smart money is positioning now. Central banks are positioning now. Institutional investors are positioning now. The question is, are you? Gold doesn't need you to believe in it. It doesn't need your approval. It's been valuable for 5,000 years, and it will be valuable for the next 5,000 years. The only question is whether you'll participate in this move or watch from the sidelines. The setup is there. The fundamentals are there. The technical picture is there. The geopolitical drivers are there. Everything is aligning for a sustained move higher in gold prices, not because of speculation or hype, but because of fundamental shifts in the global monetary system that are playing out in real time. This is your moment to make a decision, not based on fear, not based on greed, but based on a clear-eyed assessment of where the world is heading and how to protect yourself. Gold isn't the only answer, but it's an important part of the answer. It's the asset that sleeps well at night because it doesn't worry about earnings reports, central bank decisions, or political chaos. It just is. And in a world of increasing uncertainty, that stability, that permanence, that 5,000-year track record, that's worth something. That's worth a lot, actually. The question is, do you recognize it before everyone else does? Because once the crowd figures it out, once gold becomes the obvious trade, the easy gains will be gone. The time to position is when it still feels uncomfortable, when you're not quite sure, when you have to think independently. That time is now. The asset that sleeps better than you do is gold, and it's waiting for you to recognize what central banks, institutional investors, and smart money around the world have already figured out. The question is, will you get it before it's too late?